with you.
Dissension actually gives you the signal that you're coming to the end, and it is, in fact, bullish. So I think you're going to get some dissension, and that's going to send a positive signal. As far as today, look, it takes the pressure because we pared back a lot of the gains. It takes the pressure off the chairman in that press conference to ensure that he's overtly hawkish, because I think that's what he needed to do if the S&P is up at 4,100, because we all know he's trying to affect risk assets.
I want to go back to the dissension idea because I've been thinking about it today. Everything to this point has been unanimous, okay? I'm wondering what the reaction in the market would be if there was a dissent or two or three from the vote. That does mean there's now friction in the room. It means there is a two-way conversation in what has been exclusively a one-way conversation.
Yeah, but also remember that up to this point, everybody universally agreed, more or less, that the Fed was behind the curve, that they'd contributed to this problem to some degree by buying mortgage-backed securities and keeping interest rates lower than they otherwise should have been. So a lot of this, what I've called on the program with you, the easy money's been made, so to speak, in economics parlance. You're now past that point, and you're at a point where there is legitimate debate about how much additional rate hikes are needed in the market. Because there is, as Jeremy Siegel pointed out on your halftime report, again, I watched, everybody should.
Appreciate that.
There are numerous categories in there that are declining in value, not just moderating an increase, but actually outright falling. And they're peppered throughout the report. And so, again, you're going to enter a period where some people are going to say, how much more do we need to do after this 50 basis points?
Yeah, but that's one thing. I'm wondering about a legitimate dissent.
So
and what that means thematically to where we are, to the narrative.
There's precedent to this.
Now we're going to move closer to what really is the end.
So the great moderation, you know, Steve Leisman knows what I'm talking about. That's the period 1983, 1984, where Chairman Volcker and the Federal Reserve finally stepped back from aggressively raising interest rates. What preceded that pivot was dissension that wasn't present during, Dan, exactly what you're saying, a period of overwhelming consensus. This is the right monetary policy that we need to administer. So I just think knowing the indicator that you're looking for from the Federal Reserve to know when we're coming to the end is going to be preceded with a debate, a respectful debate in that room, and dissension when the statement comes out.
Well, maybe he tells you tomorrow. Here's Rick Reeder today, BlackRock. If data such as today's suggests a real trend that the momentum of inflation is lower, we could then see the Fed pause over the next few months at a still restrictive policy rate, but not one that would put potentially excessive pressure on the economy, particularly the interest-sensitive parts of it. That's sort of the point, right?
Yeah.
You are going to get a pause at some point. Do you think Powell alludes to it tomorrow?
Listen, he might, but we're all sort of dancing around the obvious here, which is they're close to the end. I mean, we are past the peak, obviously, on a year-over-year basis in inflation. We have 2 consecutive months now of a normal inflation reading, something 0.1, 0.2, 0.3, as opposed to the 0.5, 0.6, 0.7 readings that we had been getting. And if you put that together, you're at a point where you may not have to raise rates all that much, maybe 50 basis points tomorrow, and then maybe 1 or 2 more.
What does the stock market do if that's keyed in? If that's like what he alludes to, is that as important as what's already been done by the Fed? Because that's the eternal worry at this point. What they've already done, what the lag effects of it are going to be: slower economy, slower earnings, lower stocks.
Yeah, and listen, to me, and the viewpoint that I've been espousing with you for some time now is there are these lagged effects, and whether you do 25 or 50 or 75 basis points more, you are still not even a year out from the first rate hike. And so to the extent that we believe, and I think it's been proven, that monetary policy operates with long and variable legs, by the spring of next year, you will start seeing just the first effects of the first rate hikes. And so it's going to take some time for this to play out. And so to the extent you think there's a recession, the debate is not whether there will be or won't be one. I would argue that the debate is whether it happens in the first half or the second half of the year. But to your point about what the market does, we have to move past this conversation about whether to hike 50 or 25 more and start really having a conversation about how long rates are going to stay high. That is much more of a difficult decision for the Federal Reserve going forward than is to hike 1 or 2 more times.
Sure,